Hello guys, I hope everybody is fine. And I'm sure that I'm audible to everyone. So yesterday, before the class ended, we had a discussion about different types of hedging methods, and we started discussing forward contracts. We did discuss some part of the forward contract, but let us start discussing it again because the lecture was interrupted. So we were discussing that one of the ways through which a company can hedge its foreign exchange risk is to enter into a forward contract with any bank. Under a forward contract, what happens is that let's say, for example, a company is going to make a payment of say 1,000 US dollars. Let's say it's a foreign currency for the company. So 1,000 US dollars in a 1 month's time. Definitely, to get those $1,000, it has to pay in local currency to get these $1,000 from the market and then pay its liability. So it has to exchange local currency units against these $1,000. So let us assume that currently $1 is equal to 1 unit of local currency. But the payment is to be made in 1 month's time. $1,000 are going to be these $1,000 are going to be paid in 1 month's time. But the risk is that the dollar may appreciate in value, and the company may have to pay more local currency units than it has to pay today. And if it happens, it will increase the cost of the company. So that is the risk. Now, how to hedge this risk? One of the ways is to enter into forward contract. It can go to the bank and fix a rate, fix an exchange rate today for a transaction that has to take place in 1 month's time. Say, for example, the company goes to a bank and asks for a contract. The company will ask the bank that we want to purchase 1,000 US dollars in 1 month's time from you. Let's have the rate fixed today. So the bank will set a forward rate, a forward exchange rate, and that probably will be more than the current rate because of the premium, because the bank is now going to take that risk. So the bank will add premium into it. Let's say it may say that we will be fixing this rate at, let's say, 1.2 local currency units against $1 or 1.1, whatever the rate may be. So the company will enter into this contract with the bank at, let's say, 1.1 local currency units against $1. So it means that after 1 year, the company will have to pay 1.1 multiplied by 1,000. That is 1,100 local currency units to get those $1,000, irrespective of whatever the rate in the market at that time will be. Now the company has fixed its exchange rate. So therefore the company has no more any risk. It is not worried. It won't be worried anymore about the fluctuation in the exchange rate. And risk always arises when there is fluctuation, when there is variation. Now there is no more variation. Even if it is in the market, it won't be it won't affect the company. That is called forward contract. Now, as I told you earlier as well, that there are some features of forward contract. Number one, it's a binding contract. So let's say in a month's time, um, the company changes its mind of paying these $1,000 to anyone. Let's say it thought that it will be buying something in a month's time, which had a cost of which has a cost of $1,000, but now the company does not want to buy. But since the company would have entered into the forward contract, the company cannot escape from this forward contract. It has to fulfill this contract. It has to buy those 1,000 US dollars from the bank on the date fixed and at the rate fixed. This is one of the drawbacks or limitations of a forward contract. So there's a fixed rate, there's fixed quantity, and there's fixed date of delivery. Even if the date even if the date changes for the payment of those $1,000 by the company, it cannot change the date of the forward contract entered with the bank. So I hope the forward contract is now clear. Any questions before I move towards the next one? Quickly, only restrict yourself to the forward contract. Okay, let's move forward then. Okay. Now, how to predict a forward rate? How to predict a forward rate? Now, this is very important. I want everybody to note it down because most of the students, they make a mistake here, and I told you this earlier as well. In order to predict a forward rate, we use interest rate parity theory. Remember. And there's a concept behind, a long concept behind it. We don't have enough time, so I'll have to be focusing on the exam. So a forward rate is predicted by the interest rate parity theory. And according to this theory, the exchange rate between two countries will depend upon the relative difference between the interest rates prevailing in these two countries. So if you want to predict a forward rate, that is what rate the bank is going to fix today for a transaction that has to take place in the future. For that, what the bank is going to do is it has to pick the spot rate, that is the rate prevailing currently in the market, which is called spot rate. It will multiply it by the fraction. The fraction is 1 plus IA, 1 plus IB. That is the interest rate of country A and the interest rate of country B. Now, what is country A and what is country B? Now, note it down. This is again an important thing. In the numerator, the interest rate should be of the country in whose currency the spot rate is being quoted. For example, if the exchange rate has been quoted like $2 per pound, $2 per pound, right? So what do you think? In which currency the rate has been quoted? $2 per pound. In which currency this rate is being quoted? Any answer? In which currency is this rate being quoted? $2 per pound. It's quoted in dollars. It's quoted in dollars. I'm saying $2 per pound. So it's being quoted in dollars, $2 per pound. So remember this, $2 per pound quoted in dollars, 2 pounds per dollar. That means quoted in pounds, right? So it's being quoted in dollars, $2 per pound. So if the rate is quoted in dollars, the numerator, the interest rate in the numerator will be the interest rate of the country whose currency is dollar, right? And in the denominator, the interest rate will be of the country whose currency is pound sterling. That is the other currency. Now, we're not talking about a foreign and local currency at the moment. This formula has nothing to do with a foreign currency and home currency, right? Here, what you have to concentrate on, that look at the currency in which the spot rate has been quoted. You just have to look at the currency in which the spot rate has been quoted. If it's quoted in dollars, the numerator should have the interest rate of a country whose currency is dollars. And the denominator should have the interest rate of the country whose currency is the other one. Right? So this is what the rule is. So remember this rule. Okay, let me ask you a question. Let's say, um, $1 is equal to 100 Pakistani rupees, right? 100 PKR, 100 Pakistani rupees is equal to $1, right? Which country's interest rate should be in the numerator? Which country's interest rate should be in the numerator? Pakistan rupees. It should be Pakistan rupees because the rate that I have told you is in Pakistan rupees. Therefore, the interest rate should be of Pakistan, right? This is what we should be doing. So first you have to see the currency in which the spot rate has been quoted. And then the same country's interest rate should be in the denominator and the other country's interest rate should be in the denominator. And by the help of this formula, you can predict what the forward rate is going to be, right? And let me make it clear once again. The forward rate is the rate at which a future transaction is fixed today. Okay, let's take a 3 minutes azan break and we will be back. Just 3 minutes. Okay, guys, back. So I hope now you people will remember what to put in the numerator and what to put in denominator, right? Okay, let's move forward. Good. Everybody back from the WhatsApp. Okay, then we have currency options. As I told you that one of the drawbacks of the forward contract is that it's a binding contract. And if you are not sure of your transaction, either you are going to pay or you are going to receive something, but you are not sure of whether you will be paying or you will be receiving. For example, it may be a deal which isn't locked yet, but you want to lock the exchange rate, right? The deal that you have with your customer or with the supplier, whatever the case is. Either you are selling to a foreign customer, so that in that case you will be receiving next foreign currency, or you are going to buy from a foreign supplier. In that case, you will be paying in a foreign currency, whatever the case may be. Your deal with the customer or supplier is not finalized. But if it is finalized, you will either be receiving or paying something in 1 month's time. And you want to fix the rate so that you can lock the deal with the customer as well or the supplier as well. But the danger of entering into forward contract is if you enter into the forward contract and you did not enter into the deal with your customer later on, you will have to fulfill that contract. And in that case, you will be in trouble. So in that case, there is another hedging method called currency options. A currency option is like a forward contract, but there is a difference, and that is it's not binding. It gives right, but not the obligation to buyer of option. Means if you buy a currency option, you buy the right, not the obligation. For example, let's say you're going to the bank and buying a currency option, and you are locking a deal with the bank that the bank is going to deliver 1,000 US dollars in 1 month's time, and the exchange rate will be £1 sterling, right? And pound sterling is your local currency, let's say. So the pound sterling is a local currency, and you are going to buy 1,000 US dollars from the bank. And the rate that the bank has agreed will be £1 sterling, right? Okay. And the bank at the time of this transaction of buying the option will charge you a premium. The bank is going to charge you a premium. Let's say the bank said, okay, I have given you this a deal of £1 sterling against 1 US dollar, but you have to pay us, let's say, 0.1 pound sterling, that is 10 pence. So you have to pay 10 pence to us as a premium for buying this option. You agreed to it, and you paid you paid 10 pence against every dollar that you are going to purchase in 1 month's time. So that is the income of the bank now, non-refundable. You have entered into a deal. After 1 month, let's say, after 1 month, if your deal gets cancelled with the customer or your deal gets cancelled with the supplier, in this case it was supplier, what is going to happen? If your deal gets cancelled with the supplier, you don't have to go to the bank to buy these 1,000 US dollars. You have the option of buying, but not the obligation of buying these $1,000. Even if the deal with your supplier is confirmed, but in a month's time, it is cheaper to buy dollar from the market than buying from the bank from whom you purchased this option. You have still the choice to buy it from the open market instead of going to the bank. That is called currency options. So it gives the right but not the obligation to buy it off the option. Now, the date of closing this transaction is fixed. The quantity of the currency is also fixed. You can't change these two things, but you have choice not to exercise this option. That's it. This is called currency options. Currency futures, another one. Currency futures can help where you don't know the exact date of your own transaction. Let's say you will be paying 1,000 US dollar to your supplier, but you don't know what the exact date of that payment is going to be. For that, you can have currency futures. In case of currency options are useful where the date is confirmed, the quantity is confirmed, but the transaction as a whole is not confirmed whether you will be entering into the transaction or not. So where you are sure about if in case the transaction is confirmed, the date is already confirmed, but you're not sure of whether the transaction will be done with the supplier or customer or not. In that case, it's better to go for options. But in case of the currency futures, the transaction has to be confirmed. The only thing that you are not sure should be the date of transaction. In that case, currency futures can help you. And how the currency futures can help you, just look at it. So first of all, let's say, and I want you people to concentrate. It's a very tricky thing. So I need your attention. Let's say you have to make a payment of 1,000 pounds sterling and your home currency is US dollars. And that payment is going to be made in 1 month's time, right? So you are going to make a payment of 1,000 US dollar, but the current exchange rate is $2 per pound. So if you want to buy these 1,000 pounds sterlings today, each pound sterling is going to cost you $2 US. Okay, so means in total you have to pay $2,000 to buy these 1,000 pounds sterling, but that is going to be today. But the payment here is going to be made in 1 month's time. Okay, so what you can do is you can go to the future market. You can go to the future market, and what you can do is you can buy a future contract. Now, a future contract is a contract, but in this contract, you are not exchanging any physical commodity or anything physical. It's just a contract, and futures contracts are standardized contracts and they contain a standardized quantity of a foreign currency. I have taken an example. Let's say one future contract has 500 pounds sterlings. 500 pounds sterlings. Let's say one contract. So how many contracts you will be needing in this case? Who's going to tell me? Yeah, we need 1,000 pounds sterlings, and one contract has 500 pounds sterlings. So we need to buy 2 future contracts. Okay, what I've assumed here is that the rate per pound sterling in the future contract is the same as it is in the open market. So if you are going to buy dollars today, pound sterling today, they will cost you $2, and the same will cost you here as well. Though in practice or practically, the rate here will be different due to different factors. We're not going to those details. So, but for simplicity's sake, I've assumed that the rate here is the same. Okay. So you will buy these future contracts, okay? But since this is just a contract, a commitment, not the actual delivery of the pound sterling, nobody's going to give you the pound sterlings. It's just a contract for a future. So you won't be paying the full amount. Remember, you won't be paying the full amount. It's just a commitment. Like, for example, if you buy a house, but that person is not handing over the house to you, and he's saying that I'll be handing over this house after 2 months. You will never make the full payment. You will just make the down payment. So here you will just be making a down payment. A nominal amount will be paid. Okay, and I'm assuming the nominal amount here is 0, and it's just a commitment now without any financial transaction. Let's say for the sake of simplicity. So you have bought 500 pound sterling worth of two contracts. Okay, now you're waiting. The total cost of these two contracts will be $2,000. You are not paying these $2,000, so it will just take it as payable. So you'll record these $2,000 as your payables. Okay. After 1 month, the exchange rate, let's say, goes up as expected, and it goes up to $3 per pound. That's what I've assumed in 1 month's time. So what you will do is you will go to the future market after 1 month and you will sell your future contracts. And I've assumed for the simplicity's sake that the rate in the future market is the same as the rate in the open market after 1 month time. So when you will sell these future contracts, what amount of sales revenue you will generate? Who's going to tell me? I've sold these two future contracts, and each pound in the future contracts will be sold for $3. So what will be the total revenue? Total revenue of both the contracts. That's just for one contract. For both the contracts, there will be $3,000 because there are each future contract has 500 pounds, 500 into 3. So each contract will be sold for $1,500, and two contracts will be sold for a total of 3,000 US dollars. So sold for $3,000. So what will be the profit? How much did we earn through this future trading? We bought them for $2,000. We sold them for $3,000. From the future market, we will be getting $1,000 of profit, right? So we have gained $1,000 in the future market. So set it aside. These $1,000 should be set aside, okay? We are not putting these $1,000 into our pockets. So keep them aside. Okay, now since it's 1 month, the 1 month has gone, and now it's time to make this payment of $1,000 to the supplier. Now we have to go to open market. Now we are talking about 1 month later. We have to go to the open market and buy these 1,000 pound sterling. How much in 1 month's time these $1,000 will cost us? How much these 1,000 pound sterling will cost us in 1 month's time? What is going to be the exchange rate in the open market after 1 month? $3, right? So 1,000 pounds will cost us $3,000. But we will pay 1,000 out of the $3,000 from this amount because we have earned 1,000 US dollars. So what should be the net cost to us? What will be the net cost? The net cost will be 2,000 US dollars because we don't have to make this full payment out of our pockets. From out of $3,000, $1,000 will be paid out of the profits made through future trading. So effectively, we will be paying $2,000 from our pockets, and this is the same amount that we were going to pay 1 month ago. So because of this future trading, and despite the fact that the dollar rate has gone up to $3, it's still costing us $2,000, which it was costing us 1 month ago. So no impact on our cost because of the change in this exchange rate, and that is because of this future trading. Did you people get it? Yes or no? Yes, but so. Yeah, Asad, we were not there to make any profit. We were just there to eliminate our risk. The risk of exchange rate is gone. Even if this rate goes up to $4, if it goes up to $4, this will also go up to $4. And we will make a further profit from future trading, and this will compensate the additional cost that we'll be incurring here. So whether the rate goes up or it goes down, in both cases, the net cost is going to be $2,000. And somebody asked me a question, sir, what if this rate reduces by $1? That is, it reduces up to $1. Okay, then this will also go to $1. So if you purchase the contracts for $2,000 and later on you sell these for only $1,000, you will make a loss of $1,000 rather than a profit. So you will be losing in the future market, but at the same time, it will cost you less to buy these 1,000 pounds sterlings. So it will cost you only $1,000 to buy these pounds sterling, and there will be also a loss of 1,000. The loss of 1,000 plus the cost of these pounds sterling, again the cost will be $2,000. So either ways, your cost is going to be $2,000. And that's what the futures trading is all about. If you are using the future market to hedge your risk, then forget about making profit from the future market. You won't be making profit from the future market. You're just making the profit in the future market to compensate for that additional cost that you may have to bear in case the exchange rate rises. Yes, Asad, that's what this topic is all about. This topic is not about making profits from exchange rate movement. This topic is about saving ourselves from any adverse exchange rate movements, because we are not the currency traders. We have some other business, but because we are involved into import and export, we are exposed to exchange rate risk, and we want to reduce or eliminate that risk. If we lose in the future market, the only reason why we will be losing the future market will be the reduction in the exchange rate. So that impact will not only be here, then the benefit side will be there as well. So when you'll buy the currency at a lower rate, your cost will be reduced. So on one side, you will be making loss. On the other side, you will be making a benefit that the cost will be reducing. So the net impact will again be the same. So you would have made a loss of $1,000 here in case the currency rate goes down. And on the other side, it will cost you only $1,000 to buy these 1,000 pounds sterlings. So the total cost will be $1,000 here and $1,000 of a loss. So the total cost is again going to be $2,000. Well, Dua, I hope I have understood your question. You are saying that if somebody is going to buy the future contract, why can't he buy the currency directly, right? Okay, no. Actually, I told you that if someone has to buy this currency today, that someone has to pay the whole payment. And for 3 months or 2 months, it has to hold this currency, and it will be paying interest. So it will increase the finance cost of the company. Whereas if it enters into the future contract, it does not have to pay the whole amount. It will just be paying the down payment. Let's say, for example, the total amount is $2,000 and the down payment may be only $100. Here it has to pay the complete $2,000, whereas in the future market, it does not have to pay the whole $2,000. It just has to pay $100. That's why people go into the future market rather than buying the currency in advance. So this is what the future trading is. Any questions? Okay, we have money market hedging. Money market hedging on the other side is the use of money market to hedge risk. And money market is a market where you borrow money from for a shorter period of time, or you invest for a shorter period of time. So it's a market that lends that in which you make investments for a shorter period of time. So how money market can be used to hedge a foreign currency risk? Just look at this example. A UK company expects to receive a payment of US dollars 800,000 in 3 months time. Now, what are the things that you need to highlight in this type of a question? First, you need to highlight the country of the company, UK company. The second thing that you have to note is the payment. It's the payment case. So a foreign currency payment has to be made. Sorry, it's a receipt case. It's not a payment case, it's a receipt case, right? It's a receipt case. So the company has to receive a payment. And then the foreign currency, which is 800,000, and then it's the time, 3 months time. So these are the things that one has to note down before you solve this question. So the rest of the story is a very common story. It wants to hedge this exposure, the currency risk, using a money market hedge. And the spot 3 months interest rates currently available in the market are, these are the interest rates. Okay, these are the interest rates, and these are for 3 months deposits or borrowings. But remember, the rates quoted are always in annual terms. These are the annual rates, but for borrowings or deposits of 3 months. So remember that we have to convert these rates whenever we will be using, we will be converting these rates into 3 months. That's another thing that you should note. The spot rate is 1.9780 and it is quoted in US dollars. Again, a very important thing. Now, how money market hedging works. So first of all, in case of a receipt, the company will borrow foreign currency, but it will borrow present value of the foreign currency. And I will tell you in a while why. So the first step in case of a receipt, in the payment case, it will be the otherwise. It will be the deposit. But in case of a receipt of a foreign currency, the company has to borrow present value of the amount that it is going to receive. It is 800,000 in this case. So let's say it borrows this 800,000, the present value of this. And how do we calculate the present value of $800,000? $800,000 into 1 plus R. I just want you people to pick up your calculators. Just do 5 calculations for me. First, tell me, what are we borrowing? Dollars or pounds? Dollars. So we should pick up the dollars borrowing rate. We are borrowing dollars borrowing rate, which is 4.250, and it is quoted in annual terms. It is quoted in annual terms. So just convert 4.25 into a 3 months rate. Divided by 12 and multiplied by 3. And tell me what is the rate. 1.0625%, right? It's a percentage. 1.0625%. Everyone. So what we will do, we will put this rate here. Now I have put a percentage sign, which means that we still have to divide it by 100 because it's a percentage. So 1 plus 1.0625% raised to the power minus 1, and that's something you should be noting. Okay, why I did not use minus 3 here? It's a 3 months borrowing. It's a 3 months borrowing. I'm borrowing it for 3 months. Why I haven't used -3? Most of the students, they make a mistake here. They use -3 here. So my question to all of you, if anybody knows why I haven't used -3 here. No, no, no. That's not the right answer. No, exactly. Jonathan is right. Look at this. Look at this. This rate is for a 3 months period. So now 3 months will be considered a single period. If had we put here a monthly rate, it would have been a -3 figure. For us, a quarter is one period because we are taking 3 months as one period. So we have put a 3 months interest rate here. So we don't need to put -3 here. So this is something that you should always keep in your mind. We should always use a 3 months rate if it's a 3 months borrowing, but we should use only -1 here. Similarly, if it was to be borrowed for 6 months, we should have used a 6 months borrowing rate, and again here we would have to put -1. So it should only be the rate that should change, not the power. The power should always stay as -1. Okay, let's move. The present value is 791,589. Is it correct? Salman, I don't know whether you have come up with the right present value. As per my calculation, the present value is 791,589. So if somebody else could do it for me. It's the correct value, right? So that's the present value. So what the company is going to do is it will borrow this amount from a foreign bank, 791,589. So it will borrow this amount, right? After 3 months, 3 months interest will be added to this amount, and this amount will grow up to $800,000. And that's what the plan is. So after 3 months, we have to pay this bank $800,000. But we will not need to worry because we are expecting a receipt of $800,000, and that $800,000 will be used to pay this debt, which is going to increase to $800,000 in 3 months' time. So the foreign currency receipt will be used to pay a foreign currency debt. So we no more need to convert these $800,000 after 3 months, because these will be straight away used to pay a debt which is in the same currency. Now what we will be doing with these, well, this amount will be converted today because we have borrowed it today. This 791,589 will be converted today into pound sterling, that is the local currency, using this rate. We will convert these, we will sell these dollars so that we get our local currency back, and the rate will be the spot rate, the rate that is prevailing today. So what do you think? How many pound sterling we will be getting in exchange of 791,589 US dollars using this rate? Then I'll also teach you a rule of how we should be converting. First, I want you to test. I want you to test you people. I want to test you people whether you can convert them correctly. Yeah, we have to divide this amount by this rate, right? Let me tell you why we are dividing it by this rate rather than multiplying. We are converting it into pound sterlings, right? We are converting this amount into pound sterling, whereas the rate quoted is in US dollars. When you are converting a currency into another currency other than the rate, a currency in which the rate is quoted, then you have to divide with the rate. And if you are converting the amount into the same currency in which the rate is quoted, then you have to multiply. So here we have to divide 791,589 by 1.9780. So we will get 400,000 pounds sterlings. Now we won't keep this idle. We will invest them for another 3 months, right? We will invest them for 3 months. This amount will be invested for 3 months. Now this is a pound sterling amount, and it will be invested. So we'll be taking the deposit rate of pound sterling, 6.5. And again, we have to divide it by 12 and multiply it by 3 to get the 3-month rate and see what will be the future value of this investment. So put it in this formula, 1 plus 1.625%. 1 plus 1.625% into 400,197. After 3 months, this amount will grow to 406,700. And that now after 3 months, we will be receiving the pound sterlings rather than the US dollars. And this is the amount that we will be receiving in 3 months time, but we know it right from today. We know it right from today what we will be having in 3 months time in local currency. So the risk is gone because we now know what we are going to receive in local currency after 3 months. So any questions? So why we divided with spot rate? Because the spot rate is in US dollars and we were converting it into pound sterlings. The rate is in US dollars and we were converting into pound sterling. That's why we should divide. Asad is saying why we did not use the power -1. Why should we be using minus sign with a future value then? Asad, we are calculating a future value, so it should be +1. And whether we write +1 or not, it won't make any difference to the answer. Right? Now, after 3 months, what is going to happen? After 3 months, we will be receiving 2 payments. One is the US dollar payment, and the other is the pound sterling payment. We will keep this pound sterling payment, but these $800,000 will be used to pay this debt that we borrowed. So the US dollars will straight away go into that US dollar liability without any conversion. And the pound sterling will be kept by us. This amount will be kept by us. Did everybody get it? Yes, we will be solving questions now. Okay, there's a request of repeating the multiply and divide rule. Okay, let me tell you the rule of when to divide and when to multiply. We had US dollars, right? I'll be asking you questions. We were in which currency we were converting? Into dollars? No. We were not converting into dollars. We were converting dollars into, yes, we were converting dollars into pounds. But in which currency is the exchange rate being quoted? in the US dollars. We are converting into pounds. The exchange rate is in another currency. Therefore, we have to divide. If we were to convert into pounds and the exchange rate was also in pounds, then we would have simply multiplied. It's a very simple thing, though they won't ask you to calculate the interest that we have received, but it would have been a very simple thing. Difference of the two amounts, 6,700. That's the interest we have earned. Okay. Arali is asking that why we have to borrow in case of receipt. Don't you think I'm matching? Because I am receiving an amount, therefore I can borrow. Because I expect a foreign currency to be received in 3 months time, which gives me the liberty of borrowing in the same currency, because I can pay off this in 3 months time by using these receipts. Now imagine if I am going to make a payment in US dollar and I again borrow a amount in US dollars. In 3 months time, I will have to make two payments. One is the one I borrowed from the bank, and the other is the one I have to make a payment to someone. So I can't afford to have two payments in same currency. So if I'm receiving something, then I have to borrow so that that receipt could be used to pay off this liability in 3 months time. Whereas if I am going to make a payment in 3 months time, then I have to deposit something here so that I can make a payment out of this deposit in 3 months time. Is it clear? Okay, now let's move forward. I think we had enough of questions. Okay, let's go to questions now. Okay, let's go to the questions. Netven company is a UK-based company which has the following expected transactions. It expects to receive 240,000 US dollars. It's a UK-based company, right? So these are foreign currency transactions. 1 month, $240,000. 1 month payments of 140,000. 3 months receipts of $300,000. Okay. So the rates are given, the spot rates are given, the borrowing rates are given. Let's go to the requirements. The first requirement is difference between transaction, translation, and economic risk. Let me quickly give you a recap of these three types of risks. A transaction risk is faced by a company when it has entered or is entering into a transaction that involves foreign currency, and the transaction has to be settled on a future date. And the risk is that on the future date, the exchange rate may change in such a way that you either have to pay more or receive less because of that rate movement. That is called transaction risk. For example, if you have to purchase raw material from a foreign supplier, and you have to make a payment in 1 month's time. So if the foreign currency strengthens in 1 month's time and you have to pay more in local currency because of that movement, that is a transaction risk. A translation risk, on the other hand, is a risk faced by a parent company. You all have studied F7 and you all know that a parent company is required to prepare consolidated financial statements. Now, if the parent company is in one country and the subsidiary is in any other country, that is, it has a foreign subsidiary, then definitely the accounts or the financial statements of the foreign subsidiary will be in the foreign currency, whereas the parent company accounts will be in the local currency. And you have to convert or translate all the figures of the foreign subsidiary into the local currency. And you have to use the exchange rate. Now, if during this 1 year time, the exchange rate moves in such a way that you either have to show your foreign subsidiary assets at lower value, or you have to show the foreign subsidiary liabilities at a higher value because of this transaction, because of this exchange rate movement. That is called translation risk. It's just a reporting loss. The last is the economic risk. Economic risk is a long-term risk. It is a risk that a company may lose the value of its foreign subsidiary or foreign investment because of exchange rate movement due to relative poor performance or good performance of the two countries. For example, the foreign currency may be affected by the relative economic performance of the two countries. And because of the economic performance, different economic performance of the two countries, the exchange rate may change. And because of that, you may lose the value of your foreign subsidiary or foreign investment. That is called economic risk. Is it clear? The second part is how inflation rates can be used to forecast exchange rates. Now, I told you that forward rate can be calculated. Forward rate can be calculated using interest rates. You can use the same formula, exactly the same formula, but with inflation rates. In that case, you can calculate the future spot rate or expected spot rate. If you want to know what will be the expected exchange rate in 1 month's time, you have to use inflation rates. And that is called purchasing power parity theory. And so what is the difference between forward rate and a future spot rate? Forward rate, I told you, is the rate that you will fix with the bank today for a future transaction. Whereas the future or expected spot rate is the open market exchange rate that you expect to be there in the market after 1 month, 2 months, or 3 months. So if you want to predict the open market exchange rate, you have to use inflation rates. The formula should be the same that we were using for forward rate, but you should be using inflation rate instead of interest rates. But if you are to predict forward rate, then you have to use interest rates. That's the difference between the two. So it has asked to explain the purchasing power parity theory. So I have shared my course notes with you. The complete explanation of inflation rates, the purchasing power parity theory is there. You can just simply read it from there because it has nothing to do with the scenario given in the question. It is totally bookish knowledge. No application. Okay, now we have C part. Calculate the expected sterlings. The notes are in the Google Classroom, Sarfraz. You have been taking classes from the very first day. The notes are on the Google Classroom. So if anybody hasn't joined the WhatsApp group, a link of WhatsApp group will be shared shortly with you. Yes, all the course notes of financial management are on the Google Classroom. So calculate the expected sterling receipt in 1 month and in 3 months using the forward market. I will do the calculation for 1 month and I'll let you do the calculation for that 3 months receipts. Okay, so I'll do it for 1 month. Now, the first thing that you should note is we have both receipts and payments in 1 month's time. So what the company will do, it will first do netting and it will simply deduct 140,000 from 240,000. It's $100,000. And what are these $100,000? Are these receipts or payments? What is the net amount called? Receipts or payment? These will be receipts, right? So we have to hedge assuming receipts. So this is something that you should always be doing in the question, but the timing of the receipts and payment should be same. Excuse me. So now we have to hedge these $100,000 using the forward market, and we don't have a forward market rate. Do we have for 3 months? Yes, we have for 1 month, right? For 1 month, we have forward market rate for 1 month, but it has been given in a strange way. So okay, let us convert these rate as well. What does this plus minus mean? You have to add this and you have to subtract this to get two rates. And one of the rates will be called the buying rate of the bank and the other will be called the selling rate of the bank. So let us do the calculation. 1.7829 and let's add first 0.0003. Okay, okay, 1.7829 plus 0.0003, 1%. Okay, and we have the other rate which we can get by deducting 0.0003. 1.7829 minus 0.0003. So one of the two rates will be the buying rate of the bank and the other will be the selling rate, right? Okay, now we should use either of these two rates, but which rate to use? Now I'm telling you another rule of which rate you should be using. First of all, tell me whether $100,000 will be received by the company or paid by the company. Received by the company. It means the company will be having US dollars, which is a foreign currency, and it will be converting these US dollars into the local currency, which is pound sterling, right? Okay, first tell me whether the rate is going to be multiplied or is it going to be divided. I told you the rule earlier. We are converting into pound sterling, whereas the rate quoted is in dollars, so we have to divide. So one thing is for sure that we have to divide. We will be using one of these rates, but whatever rate we use, we have to divide to get it converted. Okay. Okay. Now you are going to give $100,000 to the bank, and the bank will either be giving you the bank will either be giving you 56079 pounds, These are not dollars, these are pound sterlings, right? So change it to, or the bank will be paying you this amount. So which amount do you think bank will be paying you? The higher one or the lower one? What is the benefit of the bank? The bank will always pay you the lower one, right? Which one of the two is lower? This one. So it means you don't have to take this figure, you have to take this figure. So the expected receipts will be 56079 pound sterlings. That's the answer. Asad, the $100,000 is a net figure of the receipts and payments. 240,000 receipts and 140,000 payments. So I've just netted off these two figures. We should always hedge the net amount rather than rather than hedging both of the amounts. It will cost the company. Is it clear now? Okay, let's move forward. So what you people have to do, you people have to calculate it for 3 months, right? Let us move forward. Calculate the expected sterling receipts in 3 months using money market and recommend whether a forward market hedge or money market hedge should be used. Now, should I make you people go through the lengthier process of money market hedge, or should I teach you a shortcut? No, I've already gone through that lengthier process earlier. When I was discussing the money market hedging, I told you how it goes. The whole flow chart was being displayed. But now you have a choice. Should I use the same one or should I use the shortcut? It is going to save a lot of time. Okay, so let's take a break of 10 minutes. Let's take a break of 10 minutes because I want fresh minds for that shortcut. So let us take a 10 minutes break and then we'll be back. So back, guys. Okay, let's start the shortcut method. Okay, for the shortcut method, what you need to keep in mind is first you have to identify whether it's a payment case or receipt case, right? So receipt case, and we have to do it for the 3 months receipt, right? So a receipt case, first of all, we have to see that which borrowing rate and which deposit rate we should be using. So borrowing and deposit rates, we have to identify which borrowing and which deposit rates are we using. Okay, and for a receipt, remember, for a receipt, okay, let me write both together. And you people have to memorize it, right? Okay. You have to pick the foreign currency interest rate, and the deposit rate should be of home country, and it will be vice versa in this case. Borrowing rate should be of the home country, and deposit rate should be of the foreign country. So our case is the receipt case, so we will just ignore this for a while, right? So we will consider it for receipts. Okay, that's the first thing we have to do. Then we have to pick the spot rate, right? Spot rate, as I told you, there will be two, right? So the same rule will apply. So what spot rate we used here, the same spot rate should be, the same principle should be applied here as well. So we should use a spot rate that will benefit the bank. We should use a spot rate that will benefit the bank. So we should use the higher one in this case. So 1.7820. So you just have to look at which rate will the bank, with which rate the bank will be at benefit. So here the higher one, yes. So 1.7820 plus 0.0002. So that's the spot rate. Okay. So that's going to be the rate applicable here. Okay. The next thing is to use that formula of forward rate that I taught you. The formula of forward rate should be used. So we have to calculate a forward rate, and then we should use that rate to convert the currency, and that will be the money market hedging. So forward rate, we have to calculate the forward rate. So for forward rate, I told you formula, we have to use the spot rate multiplied by 1 plus in which currency is the rate being quoted? In which currency the rate has been quoted? Dollar, right? Dollar, dollar. And dollar is a foreign currency, right? So in the numerator, we should have the foreign currency rate. So of the two, which is the foreign currency? The foreign currency borrowing rate should be used. the foreign currency borrowing rate should be used, right? So in the numerator, it should be the foreign country rate and it should be the borrowing rate. That's why we have identified it. And in the denominator, it should be the home country interest rate and that should be the deposit one. So these are the annual rates and we need it for 3 months. So first of all, go to the foreign country and that is the US dollar rate, the US borrowing rate. Which one is the US borrowing rate? 1 year dollar interest rate, that's the borrowing and that's the deposit. We need the borrowing one, 5.4%. So 5.4% should be divided by 4 because 3 months means a quarter. So to calculate a per quarter rate, we need to divide it by 4. 5.4% should be divided by 4 to get a per quarter rate. And then this should be divided by the same treatment with the home country. So 1 plus, we should pick the home country's deposit rate. The home country's deposit rate, which is 4.6. 4.6% divided by 4. Let's put it into bracket. 1.78572, we should always write it up to 4 decimal places. That's it. 1.7857. That's the forward rate. And we should use this rate to convert that 3 months receipts. The 3 months receipts are $300,000. So expected receipts will be 300,000 divided by 1.75. That's it. That's the answer. So I'm going to repeat just a quick recap of what we did, right? The first thing, you should always remember these two. So the payment one is not required at the moment, so it will be the opposite. So if you remember the receipt one, you can easily remember the payments one. So I'm just deleting it. So you just have to reverse these two. Okay. And then once you have receipt identified that's a receipt case, so you have to pick the borrowing rate of a foreign country. Now it will be the annual rate, and we need a 3 month rate, so we will convert it later. So borrowing rate of foreign country, the borrowing rate, the foreign country is the dollars rate, so it's borrowing rate 5.4. So I'm just writing it 5.4%, and let's divide it by 4 to get it simplified. That's it. 1.350%. Similarly, we have to pick the home country deposit rate, which is 4.6, and divide it by 4. 1.15%. Right? So it will be now much simpler. Let me calculate again. The spot rate into 1 plus Since the rate is in dollars, which is the foreign currency, so we have to write the foreign currency rate in the numerator, then divide it by the second rate. You don't need to remember then. And that's the rate. And then whatever receipts we are getting, we just have to divide the receipts by this rate. And that's the answer. That's it. Is it clear now? That's money market hedging for you. So if you use that, the other method that we just did a while ago, that flow chart in which the company was first borrowing and then converting and then depositing, and then we calculated the future value, you will end up with the same answer. You will end up with the same answer. Any questions? Are there any questions? Yes, in case of payment, the sequence will be reversed. The borrowing rate should be for the home country and the deposit rate should be for the foreign country, and everything else will remain same. And the spot rate is also going to change. The spot rate will be the lower one then. Okay, let's move forward. The home currency of ABC company is dollars, and it trades with the country in a foreign country's home currency is dinar. The following information is available. What is the 6-month forward exchange rate? We have to predict the forward exchange rate again. So I'm just giving you 2 minutes to solve this question, and then I'll get back and solve it for you. Just try this question yourself. we need to calculate the forward exchange rate for 6 months, right? So we need to pick the spot rate, which is 20. The spot rate is in dinars, right? So the dinars interest rate should be in the numerator. So 1 plus, what's the interest rate for dinar? Interest rate for dinar. Dinar is the foreign currency, right? So foreign currency here, the interest rate is 7%, but it is for the whole year, whereas we need it for 6 months. So for 6 months, it will be 3.5%. So I'll just write it directly. 3.5%. So this is a very common mistake that most of the students will make. They will just, in haste or in exam pressure, they will just write 7%. So it's 3.5% divided by 1 plus the other rate, which is 3%. And half of 3 will be 1.5%. 20 point up to 2 decimal place, it's 20.39 dinar per dollar. A is the option. Jonathan has got the right answer. Nikmar also got the right answer. Okay, let's move forward. Let's go to the next one. Okay, again, this is forward contract, so you will be able to solve it. So the next MCQ exactly, it's the money market hedge. So just giving you time and then I'll solve it for you. So if you have another, if you know any other way of solving it, just go and solve that way. It's financial management paper and you're free to use any method that you feel you should be using. Asad, forward rate is always set by the bank, and bank always uses interest rates to calculate the forward rate. Because it's a money market hedging, and money market hedging means you're using banks for short-term investments and borrowings. Therefore, you should be using interest rates. So first of all, tell me, which situation is this, receipt or payment? It's a payment, right? So, okay, then we will be picking borrowing and deposit. So, country, in payment case, we should have a home country here. We should have a foreign country here. Annual rates. Okay. The home country is UK. So we have to pick UK's borrowing rate. So the UK's borrowing rates in the UK are 3%. So 3%. And we are hedging it for how many months? For 3 months. So we need a 3-month rate divided by 4.75%. And we need the foreign, which is the US one, the foreign country's deposit rate. So that's 7%. And it should be divided by 4, 1.75%. Okay. Spot rate is 1.65 to 1.7, right? So which one to use? Which spot rate to use? Okay, let me show you the rule. We have to pay $250,000, the foreign currency, right? So from bank we will be buying 250,000. So how many pounds sterling the bank will be asking from us? So it means we have to convert it into equivalent pound sterlings, and that will be something that we'll be paying to the bank, and bank will always ask for a higher value. So first of all, we are converting into pound sterlings, whereas the rate is in the dollar, so we have to divide, number one, and we have to divide, and the bank is going to ask for a higher value, so we have to divide by the lower value to get the higher answer. So 1.65 should be the answer. 1.65. Okay, now let's calculate the rate, effective rate, what we call effective rate. Sometimes the question also only asks for the effective rate, then this will be the answer. So spot rate into the spot rate is in dollars, so the dollars rate should be in the numerator, and dollar is the foreign currency. So foreign currency, here we go, 1.75. So 1 plus 1.75 divided by 1 plus the other rate. Let's close this bracket. That's the rate. Write it to 4 decimal places, and the currency, the payment for the cost will be 250,000 divided by this. That's the answer. Answer is equal to D. So it's really a systematic and simple way to do it. If you just practice this method, you will always use this method. It will save a lot of your time. Since I'm also explaining things, that's why it's taking a bit of time. Otherwise, if I will be doing it for my own self, it won't take more than a minute to solve this question. It's a very structured question, structured way of solving this money market hedge. And the plus point of this question is that sometimes the examiner just asks the effective rate, which is very difficult to calculate using the other method. So sometimes it asks for the effective rate if the company goes for money market hedge. This is the effective rate, and this is in dollars, right? Remember, this whatever the spot rate was in dollars, so this rate should also be in dollars. Why we used okay, let me tell you why we used a lower rate. We are going to pay $250,000, right? We are going to pay $250,000. So we have to buy these $250,000. So in order to buy these $250,000, we have to pay pound sterlings to the bank. So Wahab, tell me, what do you expect from the bank? Will the bank be asking for more pounds, or it will be asking for less pounds? Wahab, what do you think? When we will be buying $250,000, the bank will ask for more pound sterlings or less number of pound sterlings? More, right? So we need to use a rate that will result in a higher value. So let's try both rates. 1 divided by 1.65 and 250,000 divided by 1.65. Sorry, 1.7. So which rate has resulted in a higher? The 1.65. That's why we should not use this one. This is what the bank will be looking for. So the lower rate is going to give us the higher answer because we are dividing it. Wahab, did you get it? Wahab, if you can just quickly reply. Did you get it? Okay, Hamza, inflation are there. Yes, inflation should be ignored whenever the money market or forward rates, forward contract, or in the money market hedging, we don't consider inflation rates. The effective rate calculation. It's the spot rate, it's the forward rate formula. It's simply the formula of forward rate. Okay, I am only left with 1 hour, and okay, I should let majority to choose, right? Tell me, should I continue with the details of the forex, or should I jump to computer-based exam and I should take you through that exam platform and how you should be solving in the exam. So whoever is in the favor of CBE, just write it. Both not possible. In 1 hour time, we are just left with 1 hour. So we should be focusing on one of the two. It's too much detail. The forex is in too much detail. I have tried to cover maximum areas through practice and through explanation. I'm looking for more votes before I could decide. Even I think that we should move towards the CBE because we had enough of the forex. If you practice more and you come across any problems, you can always ask me on the WhatsApp group. Okay, let's move towards the CBE platform. I will be discussing few of the questions that I believe are of generic type, and you may face them in the question. Probably why I'll be explaining those questions, that those questions will basically highlight the common mistakes that students make. So just to highlight those common mistakes, I'll be going through few of the questions as well. So I won't only be going through the platform, I will be discussing few of the questions as well. So it's a specimen exam. Janzeb, I'll just spare 10 to 15 minutes for the remote exams in the end. So whatever questions you will have in your mind, and if I have answers to those questions, I will definitely reply to those questions. Though I'm not an official spokesperson of ACCA, but whatever I know from my personal knowledge bank, I will share with you. Okay, that's the interface. You've been through it, I guess. So let me give you a quick overview of this interface. You have a formula sheet here, so you can click and you can have a few of the formulas on this sheet. You have a on-screen calculator which you can use, but it's as far as I know that in the remote exams you are allowed to use your simple calculator, your scientific calculators. So the calculators are allowed. So don't use this on-screen calculator. A scratch pad is there, but I will never recommend you to use these scratch pads unless and until you have to you think that it's complex to solve on the calculator. Otherwise, I don't think for the MCQs and CRQs you will be needing the scratch pad. So it's better not to use as much as better to use a spreadsheet or the word processing document if you really want to use something for your workings. So I'll just explain how you can do it. So here we go. There's a question. I'm not going to solve this question, but it's a simple question. You have to predict the forward exchange rate that we just did now, right? So it's almost the same type of a question that we did. Okay, you have a navigator here. So you can jump from one question to another question. Now, a very good technique will be if I were a student and I had to solve a complex MCQ that I can't do without a paper, then I would have used this technique that I'm going to tell you now. I would have gone to section C and marked a question with spreadsheet. Let's say, I don't know whether it's a spreadsheet question or not, but let's click on it. Yes, it's a spreadsheet question. So question 31 is a spreadsheet question. So what will I do that if it's a complex question and it is going to be solved in multiple steps, then I can just simply solve the question here. I can just simply solve the question here. I will just note both the questions. I'll just note both the questions, question 1 and then question 2. So I'll note both the questions. It's taking a bit of time to convert because in this case I'm using my internet, and there your question paper will be, I guess, downloaded first, and then you will be solving it. So you will have no problem in switching between the questions. So you just look at the question here, just note down the figures and solve it on the spreadsheet, and then bring the answer here. So this is a technique that you can use for a lengthier question, multiple choice questions. Okay, that's a sensitivity question, a simple question. What is the sensitivity of the NPV to a change in sales volume? It's a very simple question. All you have to do is to divide NPV with the present value of the contribution. That's it. And you will get the answer. Okay, these are the radio buttons, right? So radio buttons and the checkbox, there's a difference. In radio button, you can only mark one question. will only mark one answer. Whereas in the checkbox, you have to answer more than one. I'll just show. This is a drag and drop one, right? So this is a question that I need to discuss with you. Uh, Gurdeep plots the historic movements, and I'll first ask you people to answer, and then I'll answer this question. Gurdeep plots the historic movements of share prices and uses this analysis to make her investment decision. So what Gurdeep does is she just look at the trends, the historic trends of the share price, and then takes a decision. For example, if she feels that the share price of a company has gone so much down that from there it will only go up, from there it will only go up, right? So now she's buying this share price assuming that the share price will go up. Now what does she believe the stock market, what does she believe about the stock market's efficiency? If she had believed it's a weak form, then she would have believed at the same time that the historic movements will be known to everybody in the stock market. Therefore, the historic movements will not help us gain from the market if she had believed this. Because in the weak form, the stock market prices reflect all the historic events. She believes that the stock market is not efficient at all. That's why she believes that she can gain from knowing something about the history, believing that nobody else knows about what the historic trends are. In a stock market, majority of the investors, especially those who are trading for shares daily, they look at the historic trends. They do look at the historic trends. If you talk to anybody who's dealing with shares and ask him or her that how do you purchase and sell shares, they'll always tell you about the historic trends. Definitely, if she's buying on the basis of history, that means she believes that she's the only person who knows about the historic movements. And that's why she's buying the shares or selling the shares, keeping this view in the mind that she will be gaining from this information. If everybody else has this information in the market, how come she can take benefit of this information? So she believes nobody else has this information. And if even the historic information is not known to the individuals of the company of the market, then it's not even the weak form. It means that the stock market has no efficiency at all. Oliver believes that the share price reflect all the information at all times. What is this? All the information at all the times. Strong form. Yeah, it's strong form. Daniel, yes, if the stock market has the historic information reflected in the prices, it means it's the weak form. If it only has the historic information. Gurdeep believes that stock market does not even know about the historic movements. So she believes that the stock market has no efficiency at all. Okay. That's a capital structure question. Okay. In the traditional view, there is a linear relationship between the cost of equity and financial risk. Modigliani Miller said that in the absence of tech, the cost of equity would remain constant. Pecking order theory indicates that preference shares are preferred to convertible debt as a source of finance, and business risk is assumed to be constant as the capital structure changes. In the capital structure theory, they believe that the capital structure, that is the debt to equity ratio, has nothing to do with the business risk of the company. And we discussed it previously as well, that changing the capital structure will never change your business risk, because business risk will only be changed by your cost structure rather than your capital structure. So that's the true thing about the capital structure theory. So this is the right answer. That was not something that I was about to discuss. So here we go. Now we have a checkboxes, right? And right at the top of the question, they say two. So sometimes in the exam pressure, you may only check one of the options and you may go forward. So remember, if the checkbox is there, and even if they haven't mentioned two, it means at least two should be checked. Otherwise, it would have been a radio button. So checkbox means that there will be more than one correct answer. So remember to at least tick two if there are only two correct answers. The operational gearing formula is simply to be used, and we have solved a similar type of question previously. So just go through this specimen exam, solve all the questions, right? So I will be just discussing those questions in which usually the students will be making common mistakes. So here there is no trick in this question. All you need to calculate the contribution and divide it by PPIT. So no trick in the question. Straightforward question is there. That's again a straightforward question, so no need to discuss. So again, it's a very specific question. Here we go. Now this is the question that I need to discuss. So we have to calculate the price. It's a business valuation question. We need to calculate the price of the shares, right? And we have to use the dividend growth model. Okay. For the growth model, we need historic growth rate, the compound growth rate of historic growth rate. So which two dividends should we pick? The first question that I need to ask you people. Which two dividends we should need to pick? We need to pick. Exactly. So what should be the power? What should be the power? Yes, the earliest, the latest, and the earliest. And what should be the power? Are you people sure? It's 3 or 4. 1, 2, 3, 4. So are you people sure that it will be 4 or 3? Excellent. Excellent. Everybody is right. We should be picking up 3 as our power. But it's a common mistake that students make in exam pressures. They just pick 1, 2, 3, 4. They say the power should be 4. It should be 3 because from 2001 to 2002 it's 1, then 2, and then 3. So the number of years between this dividend, which is paid at the end of the year, till this dividend will be 3 years. Okay, great. Okay, which type of risk is this? We just discussed, a while ago. Yeah, it's a translation risk, right? Okay, again, it's a very straightforward question. I'm not discussing it, but I will recommend you people to go through this specimen exam. It's a very good exam. Very good exam. It's a theoretical question. You should be solving later on. Again, a checkbox. So at least 2 answers. Okay, now we have moved towards the MTQs, multitasking questions. Okay, and we have drag and drop. So you have to drag it in the sequence. So I think you people are aware of this type of a question. So let me move forward. But do solve the questions that I have left for you people. These are simple questions, but very good questions for practice. Okay, calculate the conversion value of the 8% loan notes of par company after 7 years. I want you people to solve this one. Solve this question. We did it yesterday. So I'll be solving it for you, but first I want you people to solve. How many shares are we going to get against the loan note? 8 ordinary shares. What's the current price of the share? 10.9. And at what rate it is going to grow? 6%. And after how many years it is going to be converted? In 7 years. So that's the answer. 131.12. 8 shares into share price into the growth for 7 years. Why PV? We are not calculating market value. They have just asked us to calculate the conversion value. Look at the requirement. Calculate the conversion value, not the market value. Okay, solve this question. It says that assume that the conversion value after 7 years is 126.15. Now calculate the market value. So just calculate the market value. So let me solve it. So all we have to do is to calculate the present value of interest payments and the conversion value, because the conversion value is higher than the redemption value. So we should use conversion value. So the interest is 8% of $100, which is $8 into 7 years. 7 years into 7 years of annuity factor. So 1 minus 1 plus the cost of debt. The cost of debt is 9%. 9% raised to the power minus 7. Divided by 9%. That's the annuity factor. So the present value of the interest payments, PV of interest, now PV of the conversion value. Conversion value as per the question is 126.15 raised to the power 1 plus, sorry, into 1 plus 9% raised to the power minus 7. And let us add the 2. It's 109. 109.27. Very well. Well done. Very well done. Let's move forward. Okay, again, that's something that you can do it easily at home. Just a repetition of the knowledge. Which two of the following are problems in using PE ratio? Yeah, that's important questions. That may be repeated. So just read this and tell me what are the two problems with PE ratio. We discussed it. Okay, let's look at the problems. It is the reciprocal to the earning yield. It is characteristic of the PE, but it is not a problem. It combines stock market information and corporate information. No, that's not something about PE ratio. It is difficult to select a suitable price earning ratio. Yes. Selecting a price earning ratio of a similar company, the similar thing is a very subjective thing. How come you can call a company as exactly similar of another company? There must be some change between a change between the two. And secondly, the ratio is more suitable to listed companies. So these are the two options. Two were to be chosen. Now here we go again. This specimen has a lot for you to solve in the risk management area. So solve these questions, and if you face problem in any of these questions, just take a screenshot and ask me on the group. Okay, so I'm just leaving this question to all of you because it's calculate the cost, dollar cost of forward market head. We just calculated this. So I don't want to spoil this question for you. I want you people to attempt it so that you have enough practice. Okay, we just discussed about interest rate parity and purchasing power parity. Just read this line and just tell me what's the correct answer. The currency of the country with a higher inflation rate will weaken against the other country. So it's talking about inflation rate. So inflation rate is related to which of the two theories? Purchasing power or interest rate? It's purchasing power. Okay. The theory holds in long term rather than the short term. So both, because that's not the difference between the two. So it will be, if it is true, then it is true for both of them. The exchange rate reflects the different cost of living in the two countries. Cost of living. Cost of living is related to interest rates or inflation rates. Inflation, so it's purchasing power. Okay, that's a very good question that we just solved it. So it is saying that if you are going for money market hedge, right? If you remember, I told you a shortcut a while ago for money market hedge, and it says which interest rate should be chosen. The borrowing rate, which borrowing rate should be chosen, and which deposit rate should be chosen. Just look at the question and do it the way I told you. So we just have to select the rates. We don't have to solve it. So we just studied a while ago. So first you tell me which will be the correct answers, and then I'll come to this. First of all, which case is this? Is it a receipt case or is it a, it's a payment case, right? Yeah, it's a payment case. So in a payment case, let's go back to our question. There was a payment case, right? So borrowing rate was for the home currency or home country, and deposit rate was for the foreign currency. So borrowing for the home, which is the home currency, dollar. So borrowing rate of the dollar 4.5%. But that's for the whole year, right? That's for the whole year. So we have to divide it by 2 because we need it for a 6 month period. We need it for a 6 month period. 6 month period. So it should be 2.25%. So 2.25 will be the borrowing rate, and the deposit rate should be for the foreign currency, and that is 7.5%. It should be, we should be dividing it by 2, so it should be 3.75%. So these should be the Okay, and that's again a very interesting question. Just read it and answer the question. It's a very common sense question. So more than a concept, it's a scenario specific question. Well, it has clearly said that it does not have any income in the currency, right? Zerona company does not have any income in pesos. So there is no chance that it can match or net off the payment. So matching is not possible. Okay. Then it says company must pay interest on dates set by the bank, must pay. So it can't lead or lag. So leading and lagging is not possible. So the two options that are left are currency swaps and currency futures. So this is a very good test of your reading skill as well. That whether you have read each and everything in the question. Okay, that's again a very good question. That's telling you what is the sequence of a money market hedge for this company. The Zerona company. For Zerona company, what should be the sequence? And we have discussed the sequence. First of all, this is a payment case, right? In the payment case, what it has to do first? Is it a receipt? Yes, sorry. Yes, hedging the receipt. It is expecting a receipt, right? So if it's expecting a receipt in foreign currency, then it has to borrow first. It has to borrow the foreign currency, which is euros, convert into local currency, invest the local currency, and then when it receives the foreign currency, it will pay the loan that it borrowed in the first step. So now let me give you a hint. This first step and last step should match with each other. It should be a flow, right? So use the customer payment to repay the loan. So it will only be possible if you have borrowed here. Let's go forward. Okay, this is a very specific question. Definitely not expected to be repeated, but let me tell you. In relation to the company, which two of the following statements about competition and deregulation are true? Let me explain the deregulation thing, and then then we'll move forward. I don't think we need to discuss the options. Deregulation and regulation. Regulation means when you have regulations imposed by the government on how you should be competing in the market. For example, maybe the government has imposed duties for the newcomers so that there is no competition. Maybe the government has introduced different laws to protect competition. That is called regulation. And deregulation is where government allows new entrants to come into the market and compete in the market. So you don't have strict regulations in the market. So it's easy for every business, every organization to start the business. So that's the difference between deregulation and regulation. So go through this specimen exam, right? And solve the questions as if you are in the exam. I have done few of them, but you should go through all of them and solve it as if you are in the exams, and take a screenshot of any question that you may feel you need to ask. Now it's section C. So this is the part that I really wanted to discuss with you uh, about the formulas, right? We have NPV formula here. We can apply NPV formula, but just look at this. When I write NPV, it does not give me any hint. It does not give me any hint, which means if I have to apply the NPV formula, I have to remember the whole structure of the formula, right? So that will be difficult to remember every formula's structure. And in F9, the very common formulas that you may be applying, which is simple, is the sum formula, where you just have to write sum, open up the bracket, and define the range you want to. So I would recommend don't use NPV formulas and IRR formulas, because if you made a small mistake, you will never know that you have made a mistake, because the formula hint is not there. So you can lose your marks. So better not to use these formulas for NPV, for IRR. Better to do it the way I taught you to do it. Okay, let me explain few things that you can do with this limited level of spreadsheet. You can do some styling work, bold, italic, and underline. You can also text. You can also color the text. So you may use headings with the color text. So you can do it and choose a color of your own choice. You can also shade the cells, which will be very good if you are doing formatting of the columns or column heading. Let's say, for example, we have 4 columns and we just chose a color from here. Let's say this is, and we just wrote year 1, year 2, year 3, but don't use it unnecessarily. When it should be for the beautification and highlighting things. So don't do it unnecessarily. Wherever required, do it only then. You don't have any there are no marks available for these things, so don't use it unnecessarily. Then you have alignment. If you want to align it to the center, you can use these tabs. Uh, if you want to write in decimal places, this is the one that you can use. If you want to convert it into accounting format, like for example minus 5,000, I've written it as minus 5,000, so I want to put brackets around this figure, so I just have to click on this and I get a list of the formats. So from here I can choose a format of my own choice. So I'll just choose this one, because this is the one that I want. The positive value should be shown with the dollars value up to 2 decimal places, and the negative one should be shown with the brackets. So that's, and we can also increase or reduce the decimal places, which I can't see at the moment. It should have been here. That's it. It's a simple format. Use this. There used to be a tab for changing the decimal places. I don't know, it's no more shown here. Okay, we can show it in the form of percentage, and I've always used uh, this format. I've always used this format for percentages, and you should always use this format for percentages. Don't multiply it with 100. Let's say, for example, you are using 20, you are just trying to calculate a percentage of 25 as a percentage of 150, let's say, and you just multiplied it with 100. Don't do that with, don't do this mistake. Just use this percentage sign to show it as a percentage, and you can show it up to 0 decimal place, up to 2 decimal place. And that's why they haven't given the decimal tab, because in every format they have given the option of choosing the decimal places. So you should use this percentage format wherever you are using the rates. Okay, that's it. We don't need usually. And within the spreadsheet, within the same spreadsheet, you can also copy paste things. So you can just copy, Control C, and come here and paste it, Control V. But you won't see those uh, highlighted bars around the cell, which you usually see in an Excel. In Excel, when we copy it, we see the highlighted bars going around the cell, showing that this cell has been copied. But here you won't see, but you can still copy and paste. Okay, and now what else? Okay, someone has asked that, sir, how can we border it? There is no option for bordering, but you can underline certainly. So bordering is not there. You can underline any text. For example, if you want to underline this, you can just simply underline. So bordering is not there, but there are no marks for beautification of the text. No, MCQ text cannot be copied to the spreadsheet. I have checked. Okay, let me first discuss a theoretical question as well. Here is it. Okay, now the beauty of the computer-based exam is when you see a question and it says briefly discuss your findings, right? So what you need to do is just do a brainstorming session and just first write the key points. Like you said that the first point should be, and let's say bullets, the first point should be I need to discuss interest coverage. So you may forget it later if you don't write it down. Interest coverage ratio, and then you said I will discuss the gearing ratio. Then you said I'll just discuss the EPS as well. So just write the points that are coming in your mind that you think you should be discussing. So once you write them, then try to explore these points without looking at the sequence first. Just try to explore these points. So write about the interest coverage, whatever you want to write. Then write about the gearing ratio, then EPS, and whatever you write. And then see which should be taken to the first point, which should be taken as a first point. So just copy it and take it at the top. So rearrange the points as it should be. So it's very easy to do it in a computer-based exam. You can't do it with a pen and paper. So that's, and whenever there's a table form data, do use tables. Okay. Any questions about this platform? Then I'll move towards the remote exam thing. No, things can't be copied from one question to another question. You can't copy something outside this box. All these are related to this inside thing. Okay, now let's discuss the remote exam thing. So any questions about the remote exams? Maria, I don't think it will be difficult because in MCQs you will have usually 2 to 3 lines question or 4 lines questions, and there will be hardly some figures that will involve multiple steps. So I think you can do it with calculators. Yes, Scratchpad. With Scratchpad it will be difficult, but I don't think you can't solve it without Scratchpad. It can easily be solved without Scratchpad. No, in the remote exams you can't go and take a break. There are no breaks available. Well, Asad, for that, Asad, did you book the exam? Did you book the exam? Yes. So you must have received an email. In that email, how you should be joining your exam, all the details will be in that email. No, Huma, it's not possible because you have to show the room, you have to show the walls of the room. So they will be asking you. And even if you have, you can't have a paper behind the screen, but even if you have, what you'll be writing in that paper, you don't know about the exam. So it's impossible to cheat. Well, they will give you some time. You will be the proctor will guide you if any disconnection occurs. He will guide you before the exam that how you will be reconnecting to him. So he'll be sharing some details, a link with you that how you can reconnect. Well, the first thing for the remote exam is don't listen to anyone. Yes, you take a guidance for people that what are the don'ts, what are the do's and what are the don'ts. As far as the guidance is concerned, you can take guidance from anyone, but don't borrow the fear factor from anyone. Believe me, if there is no technical problem, okay, which can be even in the center-based exams as well, but if there is no technical problem, believe me, you will never want to take your exams in any center anymore. You will be very much relaxed while you're taking exam at home. I have students who took the exams at their home, and when I asked them that whether if you get a chance in the future to take exams in the center, will you go for it? They said no. No, never ever try section C first. Always go for MCQs first. Go in the sequence. The reason is in the long questions in the CRQs, there's a big chance that you may get stuck, and if you get stuck, you will lose time. So better to go for MCQs first. They are small, so you can afford to leave if any question is difficult or you don't get it right. So you can leave the question and you won't lose the confidence because it will be only for 2 marks. So first of all, complete your MCQs, CRQs, and then come to the last part. Well, Daniel, I exactly don't know how exactly you will be doing this, because this is something that the student will know and the proctor will know. So that will be the proctor who will be telling you how he wants to know about the rule. Okay, let me give you a few generic tips of how you should be preparing for your exams, right? And what you should be doing on the day of exam. Uh, first of all, first of all, that's something that I always tell my students. You should have a self-belief that you can do it, and especially those who have flunked this paper before as well. You should you should forget that you have ever flunked. You should only remember the mistakes that you made. Just remember the mistakes that you have made. Don't remember the result. Number one. Number two, all of you have enough number of days left, so you can do miracles in these 22, 23 days. Financial management paper is very easy to manage. All you have to do is to take care of the small mistakes, the tiny things, especially the things that I was telling you to note down. Thirdly, from now onwards, what you need to do is just pick up the handouts, go through the handouts of a particular section completely. Once you have gone through the handouts, you have covered the theoretical part, the conceptual part, then mark few questions from that area and solve as if you are solving in the exam. The first question should be the one you have already solved, but the second question should be the unseen question. And when solving the unseen question, make sure you don't look at the solution unless you have solved it completely. And it will be great if you can just exchange your solved copies with each other and ask each other to solve, to check the copies and give remarks to each other. That's the best way to improve. In this way, you will also uh, get into the shoe of the examiner. You will, by checking someone else's copy, you will know what common mistakes usually people make, so that you should not repeat those mistakes. So now you have a very good platform in the form of that WhatsApp group where you have more than 200 students. So you can make groups, you can make study buddies from that group, and just solve a paper, send it to your friend, ask him to check for you, give a remarks, and you do it vice versa, and help each other in this way. Well, only go through the textbook or Kaplan if you feel that the topic isn't comprehensively discussed in the course notes. And before going into exams, I would request you to at least solve 2 past exam questions completely from A to Z. 2, at least 2. Okay, Taha, I will share it on the group. So I'm ending the session. It was wonderful 5 days with you, and you people were really patient and were very responsive. And I wish you all best of luck for your exams. And I will be in touch with all of you on the WhatsApp group. So if you people have any questions, but if I reply you late, do excuse me for that. You can repeat your question once, twice, thrice, but I will definitely reply. Inshallah, sir. So guys, take care. Bye bye. That's a pleasure, Ahmed. It's really a pleasure. And I'm waiting for all of you, or for feedback from all of you on the WhatsApp group. So drop a feedback on the WhatsApp group. Thank you so much. Have a good day.